Okay, going into 2020, we have a positive outlook on emerging markets, and we'll identify maybe three main reasons for that view. The first is liquidity, then growth, and then trade. Now, starting with liquidity, we would just highlight the idea that has been published in our colleagues that do our Global Financial Trends publication, where they note that the continued purchase by the Fed of assets until Q2 is going to provide a boost to global liquidity. And it's not just, I mean, the US is leading this increase in liquidity, but other developed markets are also following through with an increase in liquidity too, which is going to provide a boost to emerging markets. Now, emerging markets themselves, the liquidity outlook is somewhat more mixed. So in China, we had the flooding easing, so-called, of 2015-2016 that produced a massive increase in liquidity. So that has now come out of the system, and the situation has stabilized there. And in other emerging markets, certainly looking in terms of broad money growth, we have a more mixed picture. But even so, we think that the developed market driver will be a positive impetus to emerging market assets. Moving on to the second of those factors, which is growth. Now, there isn't really a strong acceleration of growth among major emerging market economies, except with the possible exception of Brazil. So in Brazil, coming from quite a low base, we are now starting to see signs of the economic recovery coming through there. So that's going to provide some positive momentum. Now, that's not big enough to support all of the emerging market asset class, of course, and really the main driver from the growth perspective is going to be China. Now, China, of course, has been slowing for much of the past year, but we now believe that growth slowdown has stabilized, and that stabilization in itself is, if you like, a positive delta in terms of growth, which will be supportive for the emerging market asset class. Moving on to trade. So the agreement of the phase one deal between US and China is positive. I mean, a lot of the details in terms of the things that will directly affect markets, so tariffs, for example, have been known for a while. The deal had been anticipated, so there isn't going to be a huge positive spike in markets because of that. But the deal itself nevertheless sets out a framework for continued dialogue. And that really means that we now expect an extended pause in hostilities between US and China. I mean, that's not to say that we'll move quickly on to a phase two deal, of course. The issues that go to the heart of China's state-directed economic model are still going to prove difficult, if not impossible, to address. But certainly for the remainder of this year, we expect this pause in hostilities and an end to any further tariff escalation, and that will be positive for world trade. And this is happening, of course, at a time when world trade is already starting to bottom out. So we track a number of leading indicators for trade, looking at export orders and export growth, semiconductor exports and so on for a number of countries, including Taiwan, South Korea, Singapore, and so on. And this having shown really a declining, increasingly negative year-on-year contractions in trade for many months. This indicator, which now looks 3 months ahead, is starting to show a pickup in world trade and obviously in emerging market exports. Now, this is a pickup that is still going to be negative in terms of year-on-year growth, but that a negative contraction is now decreasing. So we interpret that as an indication of a bottoming out of world trade, which will be positive for emerging markets. So in addition to those three factors of liquidity, growth and trade, we would also highlight interest rates. So interest rates in many emerging market economies have been cut to record low levels. Brazil, obviously we've mentioned the economic recovery there already, and the record low interest rates there are clearly a positive both for equity markets and for economic growth. Also, in the case of Brazil, we expect this record low interest rate to trigger a reallocation of financial assets. So many investors who perhaps had previously focused purely on fixed income will now start to rebalance more towards equities. So that will be positive for that market. Elsewhere, interest rates have also been cut to very low levels, but we would note that the disinflationary drivers that have been behind these interest rate cuts are perhaps now starting to subside. One particular element to note is PPI in China. So we model PPI looking at a number of industrial inputs, and our expectation now is that PPI will come from levels around now around -1%, having come from -2%, will probably drift higher towards 0 or maybe even +0.5%. So the exported disinflation from China that has been impacting other emerging markets is now going to decline. So this changing of or kind of end of the monetary easing cycles in some emerging markets is going to contribute to a more divergent outcome among the emerging market economies. One factor behind the dollar weakness had previously been the Fed monetary easing, but of course now that easing is on hold, likely for the rest of this year, and that means that one of those factors that has been behind dollar weakness has now been removed. Another factor that has helped to ensure a soft dollar recently has been this expectation of reduced hostilities between the US and China. And that now too, with the signing of the Phase 1 deal, there's really very little more in terms of a driver of dollar weakness to come out of the US-China story. So with those two factors of dollar weakness now removed, we're expecting more of a range trading outlook for the dollar. And what that means for emerging markets is that we're not going to have this positive driver. Is there will be perhaps more reason to pay attention to which emerging markets, economies and assets are less vulnerable to dollar strength. So the bottom line is that we will have a more divergent set of outcomes amongst emerging market economies and assets. Finally, moving on to our country calls that we present monthly in our asset allocation heat map. So China and Brazil, we've said we're positive for primarily growth reasons. In Brazil too, we're going to see a continuation later in the year, of course, of the fiscal structural reforms that they've been doing, and also a privatization program which should boost markets. Outside of those two countries, India, we're positive on at the moment. So there are medium-term concerns in India, and that we don't expect the government to return to the positive structural reform momentum that we saw in Modi's first term. But nevertheless, we are seeing fiscal stimulus, and particularly the corporate tax cut and the prospect perhaps of an income tax cut to come. These are things that we expect to drive at least the part of the economy that foreign investors care about, even if some other aspects of economic growth are not yet recovering. So a positive story on India. Also positive story on Russia. So there, again, we've seen low interest rates, which are benefiting the economy, and inflation, of course, is also well anchored there. We also should see starting to come through this year some fiscal stimulus ahead of the 2021 elections, and the other big issue, of course, is geopolitical risk. So the risks in Ukraine, we're seeing an ongoing peace process there, and that should reduce that as a negative driver of geopolitical risk. Of course, the US sanctions and the tensions in the Middle East are still an underlying concern to investors in Russia. So positive on China, Brazil, India, Russia. Negative on Mexico at the moment. I mean, there are some positives in Mexico in terms of expectations still of further interest rate cuts, which should at least benefit the fixed income markets. But we're concerned about the counter-reform agenda of the AMLO administration, which is a medium-term risk. In the short term, The concern really is about economic growth, the failure really of that growth to pick up there at a time when other emerging markets like Brazil, for example, in comparison, are experiencing something of a growth recovery.